Hi everyone, welcome to our new lesson. It's about the journal or general journal. This is the last of the books of original entries we've been discussing since we started this term. Just to remind you again, we have covered the 4 journals for the stock and 2 for the cash, and this is the last one, which is for catch all kind of transactions. So the basic rule is, if a transaction does not fit in any of those 6 journals that we have covered, to name them again: sales journal, sales returns journal, purchases returns journal, cash book, and petty cash book. So if a transaction does not fit in these 6 journals, it will end up in the journal or the general journal. Another thing which I would like you to remember for now is, if a business has not adopted to use more than one journal, they will use this journal. So if a business say they don't want to keep the complete set of records and they don't want to have 7 journals, they may choose to have only one journal, and that one journal would be this one we're going to see in a while. So remember, if there is just one journal a business is using, this will be the one. Okay, so let's move on. So you can see on this slide, the first bullet point, it contains the original record for those transactions. So let's underline, if there is no other appropriate journal. So if you don't find any other appropriate journal, and when we say appropriate journals, let's make a notation beside it, one of the 6 journals. So you have to first check those 6, one of the 6 journals, and we have covered those 6 journals already. So if it is not fitting in one of those 6 journals, it's gonna come in general journal. The other name for general journal is the journal, so let's highlight the alternative name. And then you know, all journals have the source of information. The records in the books of original entries, they come from source documents, and same here, you would need a source document to make a journal entry, and those source documents, they will vary, since this is a catch all kind of journal, so it doesn't just record one type of transactions, it records more than one type of transaction. So the document will also depend on the transaction. So it could be an invoice, it could be an internal voucher, or it could be some other document, which may be prepared internally, and you're going to see it when we make entries in this journal. So let's move on. As I said, this journal records those transactions which do not fit in other journals. So the list can be long, but these are the typical ones which are recorded in this journal. Mind you, you don't have to make all of these entries in this journal for now. Some of them will be coming in subsequent chapters, so you would see a lot of transactions, and we'll see many uses of this journal in the coming chapters. So we'll just give you a kind of feel of this journal and how it looks like, and we will not really try to exhaust all the transactions that may fit in this journal. So this is a kind of representative list. For example, goods taken by the owner for his own use. Okay, so the key word here is the goods. So let's circle it also, although we have highlighted it, but let's see the goods also. So if an owner of the business takes goods for his own use, they will be recorded in this journal. If you remember, when the owner took cash or money from the bank, it went in the cash book. But if he takes goods or any other non-cash asset, it's going to be recorded in this journal. And then they can make an internal voucher for that, detailing what goods and their quantity and the price and all, and it can be used as a source document. The next one is non-current assets purchased on credit. Again, we'll highlight and we'll circle the word on credit. So the key word is, if a non-current asset is bought on credit. So 2 things are important. It has to be a non-current asset, and it has to be bought on credit. So we'll circle the non-current asset also. And do not mix it with the goods purchased on credit, because for the goods purchased on credit there is a journal which we have already done, and if you remember, it was purchases journal. So two key things: it has to be non-current assets, and it has to be bought or sold on credit to end up in this journal. Then end of period adjustments, we'll just skip it for a while, but just remember for now that this is one of the use. Then canceling some entries, correcting errors. One or two correction of errors we'll do here, and the other ones we will do later in grade 10. Opening entries we will do now. We'll show you how to make opening entries in the journal, and then making transfers between the accounts also. Some we'll do now, some later. And bad debts again, you may come across one because you know what are bad debts for now. But the details of that will be again in another chapter, and that will be covered next year again. So let's move on. So this slide here, you can see the layout of this journal. So let's see the columns. The first column is date. You know, all journals have date columns because journals record the transactions in order of date. Then all journals have details column. Okay, and then there are two columns for the amounts, debit and credit. Okay, so before I move on, I just want to make a clarification here, or a kind of thing that pops out at you. Do not mix this one with the trial balance, because the trial balance also has two columns, one debit and one credit. But if you compare the layout of trial balance with the journal, you will notice the difference, that there is no date column in the trial balance separately, and the details are also different, you know. So do not mix with the trial balance. So we'll make a notation for that on the side. Do not mix with trial balance. So just bear with us for a second while we make notations. So do not mix with trial balance. This is not a trial balance. It may look like, when you have first look, it looks like the one, but it's a journal. Trial balance, you know, just is a list of balances. Okay, now in the details column, if you see the first thing, which is along the margin on the left, name of the account to be debited. So the first line should be the name of the account to be debited. So you will read the transaction and you will see which is the debit account there and put it first. Then in the second line you will indent it a bit. So let's show you the indent first. So just move towards the right, like on a keypad you press the tab button and it moves to the right. So just move a little bit of the space, just a small indent to separate it, and then we write the name of the account to be credited. So the first line, the name of debit account, and the second line, the name of credit account. Okay, and then the third line is the brief description of the transaction, which is called narrative. So let's circle the narrative. This is important. And why narrative is needed? Because this journal does not record only one type of transaction. So every transaction may be different. So it has to be explained for the reference purpose, and also the person who's reading the journal, he can make out, because he may not be a person knowledgeable in accounting, you know, so he can make out what has been recorded. And then there are two amount columns, if you notice. So the debit amount and the credit amount. So we'll have the debit amount and the credit amount. And mind you, these two have to be equal. Okay, so these debit and credit amounts have to be equal. There may be more than one account to be debited and credited, but then at the end the total of the debits must equal to total of credits. So this is the layout. Again, a quick summary: date, details, debit, credit, and the first line is for the debit account, second line has to be indented a bit and it's for the credit account, and the third line is the description of the transaction in your own words, which could be a short form of the transaction itself, and that is called a narrative. So let's move on. Here you can see the we'll pause it for a while and we'll resume it in a minute. Just bear with us for a second. think we have some hiccup here. Let's carry on. Let's finish it off. This is a practice question 1 on page 107, and it has already been solved, but we'll just review it one transaction at a time. You can look up in your textbooks on page 107, and the transactions are there. The July 3rd transaction, it says purchase new equipment. So it's a non-current asset, so let's circle it. So here you got a non-current asset. So we'll just make a notation NCA. Just this is your NCA, and it has been bought on credit from the supplier J. Raja. So if you see, first line is the name of the account to be debited, and the second line is the name of the account to be credited, and then the debit and the credit amount, and then there is a narrative, and the narrative is equipment bought on credit, and there is a reference for the invoice number which you received from the supplier. The next transaction is a correction of error, and it says the bookkeeper made a mistake when recording a sale of goods 780 on credit to TM Williams. So you sold goods on credit to TM Williams. You made a correct entry in the sales account, but the account of T Williams had been so instead of TM Williams, you put it in another customer's account called T Williams. So owing to the similarity of the name, you mix the names up. Now originally you would have recorded this transactions in the sales journal, but you will not do the correction there. You will leave the wrong entry in the sales journal, and you will make the correction here, so that when you check it or someone else checks it, they will know like there was an error somewhere else and now it has been corrected. So the correct customer to be debited was TM Williams. So we'll debit the correct customer. So we'll make a notation, the correct customer. So this guy is your correct customer who had to be debited. So we'll debit the correct customer and we'll credit the wrong customer. So by, just bear with us for a while, we'll move it up a bit. So this is the correct customer. He was supposed to be debited, but you did not. So now you are debiting him, and this wrong customer who was debited now is being credited to cancel it, so basically it's a transfer, so you are removing the amount from the wrong customer and entering it in the correct customer's account. So you can see the narrative showing that the error has been corrected. Okay. The next one is related with the one which happened on 3rd when the equipment was bought. Now we are returning some of this equipment, and if you see, it's exactly the opposite. So we'll join the July 3rd with July 19. Just bear with us for a while. So July 3rd and July 19, yeah, so you compare them and you can see July 3rd you are buying the equipment, and July 19 you are returning the equipment. So you just swap the transaction. So the account to be debit is J. Raja now, and account to be credited becomes equipment, because your equipment is decreasing, and the asset decreases credit, and your liability is also decreasing. So decrease in the liability is debit. So the equipment which was worth 3,600, now some of this equipment has been returned. And if you see, the narrative shows that damaged equipment has been returned to the supplier. The next two entries, we will not spend a lot of time explaining them, because they will come again once we do the income statement. We haven't done it yet, but for now only the transaction which is 31st, both of them are 31st. It's just the purchases accounts being transferred to the income statement. So what we are doing is we are just transferring the purchases from purchases account to income statement, and on the side we will make a notation that the purchases account has been closed now. So purchases account closed to income statement. And what does that mean? When we do income statement, you will see it in detail. So for now we just make a notation, purchases account has been closed, and whatever was sitting in the purchases account has been transferred to income statement for the purpose of profit calculation. And the next one is again a similar one. Something which has been closed to income statement. It's revenue being closed to income statement. So the previous one was an expense being closed to income statement, because purchases is a kind of cost or an expense. And then this one is an income being closed. So we'll again make a notation on the side at discount received closed to income statement. What does that really mean in detail? We'll see when we do the income statement. So for now, this does the journal practice question, number 1, page 107. And let's move on. Now here on this screen, I have a table down there which we have left blank, and we're going to fill it up together as I guide you. So this is practice question 4 on page 107. One column is for the transaction. I will not copy the transactions. You can look it up from your textbook. I will just write the date here for the transaction. For example, the first one is September 3rd. So I will just write Sept 3rd, September 3rd. And the next one is 6th. So we'll just write 6, and then 11th, and then 14th, 15th, 20th, 23rd, and then we have 25th, and then 30th. So these are the transactions on different dates there. So I'll just put the dates here. You can look up from your textbook the transaction. And the next column is, just bear with us, next column is for identifying that which book of original entry or the journal or the prime entry you're going to use for each. And the third column is not required in the book. I have added it, so let's make a notation in the bracket beside. Just make a notation that reason not required in the original question. So this was not required in the original question. So I've just added it because it basically improves the understanding, that why are you using the book you are using. So let's carry on with it. The first one is September 3rd. It says received an invoice for some new equipment for the business use. So when you receive an invoice, it's always a credit transaction. And so it's a credit transaction, but then you have to see that what has been bought on credit. It's the new equipment, which is a non-current asset. So two conditions are met: non-current asset, and it is bought on credit. So the book use will be the journal. So the journal, and the reason is, so in fact two reasons. That a non-current asset. So we'll write it as one. Non-current asset bought on credit. So we will circle NCA and on credit just for highlight them. Highlighting is better. So we'll highlight, okay, circle them. So non-current asset and on credit. So these two things are important, and that's the reason why it is going in the journal. The next one is check stub. Check stub is like check counterfoil. Check stub showed the payment for rent for the month. And you remember all check payments and all check receipts, they go in the cash book. So cash book. And the reason being a check payment. So it's a check payment. So we'll circle the word check, and we'll also make a notation money because it's a transaction which deals with money. So anything with money, goes in either the main cash book or the petty cash book. And since this one is a check, so the checks end up in so we'll move it up a bit so that the next row becomes available for 11th. Just bear with us for a while. Okay, the next one is on 11th, and it says entries were made to correct a mistake made by the bookkeeper. Now this is a simple one because whenever you make an error of correction, you should know that it goes in the journal. So the journal. So the journal, and the reason being correction of error. And we have seen in the list of uses of the journal that correction of errors is done originally in the journal. Again, mind you, we do not correct the error where you originally made it. So if you made an error in cash book, for example, you will not correct it in the cash book. You will correct it in the journal, and then it will be eventually posted in the rest of the books. Then on 14th, invoice was issued for the sale of goods. Again, the word is invoice, but then we have, so it's a credit transaction, and it is for the sale of goods on credit. So it will go in the sales journal. So this one goes in the sales journal, and the reason being goods bought on credit, because the goods have been bought. So goods on credit, and we'll circle the word goods and credit. So because goods have been bought on credit, so we'll circle the word goods as we circled in the first transaction, NCA. So if you see, again, if you compare the September 3rd transaction with 14th, in both transactions you are buying something on credit. The difference is, the first one you are buying a non-current asset, and in the other one you are buying goods on credit. So mind you, you have to be careful about that. Then 15th, a credit note was issued for the returns of the goods by a customer. So a customer returned you the goods and you issued a credit note for him. So if you remember, this goes in the sales returns journal. So sales returns journal, and the reason is goods returned by a customer. So again, the key word is goods. So goods returned by a customer. So we'll circle the words goods and the customer, so that you know that they are the sales returns. So customer has returned you the goods, so they will go in sales returns journal. So wherever you see the word goods, the possibility is one of those four journals: the sales journal, the sales returns journal, or the purchases journal and the purchases returns journal. Then on 20th, a voucher showed the purchase of postage stamps. Now you see the word voucher, that's normally used for petty cash book, if you remember. And also another indication is that it's only for the postage stamps. So it's a very small expense, so it's a small payment, and it's a voucher, So the petty cash book, so this will go in petty cash book, and the reason being postage stamps, okay, and the vouchers, because it saves and the voucher. So these two things are showing you that they are going to go in petty cash book, and we'll also write a small payment just to signify that it's a small payment. And we'll make it a bit smaller in font so that it doesn't go in the next line. So just bear with us for a second. Can reduce the font size, or try to squeeze it in the first in one of the rows. We'll wait for some time, make the font smaller, select it, and then we'll make it smaller. Okay, so this does it. Then on 23rd, invoice was received for the goods for resale. So invoice was received. Now again, you are receiving an invoice, but that's for the goods you are buying. So this would go in the purchases journal. Now you can compare it with the one on 14th, whereas there was a sales journal. I think on the sales journal, let's make a correction there. We will just change the goods bought to goods sold, because here the goods were sold on credit, because the invoices issued, they go in the sales journal. And on 23rd, we have received an invoice, so we'll again say goods bought on credit now. So this is the one, goods bought on credit. So we'll circle the word goods, and we'll circle on credit also. So this shows you that again, if you notice, it's for the goods. So whenever it's for the goods, it has to be one of those four journals which we did earlier. The next one on 25th is some of the new equipment was found to be faulty and was returned to the supplier. So again, this is opposite of what happened on 3rd of September. So you are returning some of the equipment. So you are returning a non-current asset, so that would go in the journal. So equipment returned. So again, equipment, which is in the bracket, will write NCA, so that's your non-current asset, and we have returned it. So equipment is returned. It cannot go in any of the returns journals, so it has to end up in the journal. So we'll circle equipment here because it's a non-current asset. The last one is expense accounts were closed to transfer into income statement. So again, it is a transaction which is transferring one account to another account, so that would be the journal again. Okay, and the reason being transfer the balance of an account to income statement. So the reason is transferring of an account balance to income statement. So transferring an account balance to income statement. Just bear with us, we'll just make the font size a bit smaller to fit in the row. It does now. Okay, so that finishes it. Alright, so this was an exercise in knowing which transaction, which journal. We'll do more practice on it also when we have the live session, but this will be basically a guide for you to really decide which journal, and also a reason that why we are using the journal we are using. So that does it for now. So we'll sign off for this recording, and then we'll see you during the live session to explain more on it.